This class is dedicated to my former professor and boss, Mr. Tom Frecka. Tom is retired but continues his legacy of teaching. Tom, thanks for watching these videos and giving me tips and support as I walk in your footsteps. Keep fighting to make a difference. Welcome back for class number 16. In our last class, we kicked off our unit on investing with an intro into equity securities, or what most people know as stocks. In this class, we'll talk about another type of investment called debt securities, including bonds. You might recall that we talked quite a bit about debt investments in class number 11 when we introduced the time value of money. If you haven't seen class number 11 yet, I would strongly suggest watching that video before taking this class. Since most novice investors are much more familiar with equity securities than they are with debt securities, I'm going to start off with a quick refresher. You know I love definitions, so let's begin with an important one. What on earth is a debt security? A debt security is a type of investment that represents a creditor interest in a company or a government. That is, the company or government is looking to borrow money and issues debt securities to investors, who, by virtue of buying the debt security, are essentially lending money to the company or the government. Here, the investor or creditor is the lender, and the issuer is the borrower. When you buy a debt security, you will normally receive either a fixed or a variable interest rate to compensate you for the time value of money and the risk that the borrower is not able to repay the debt. When a borrower is not able to repay its debt, it is said to be in default. Both governments and companies can and have defaulted on their debt in the past. There are a variety of types of debt securities, including bonds, bills, notes, etc. What they are called isn't all that important, other than for identification purposes. Debt securities will almost always have a maturity date when the principal amount borrowed must be repaid by. Many debt securities are issued and traded over the counter from investor to investor using a network of brokers and dealers. However, some are traded on an exchange, also called a bond exchange. Debt securities have prices just like stocks do, but their prices are highly dependent on interest rates, since a primary reason why investors hold debt securities is to earn interest. When a debt security is first issued, the interest rate offered will normally reflect interest rate levels at that time, as well as an assessment of default risk of that borrower at that time. Government debt securities, like those issued by the United States Department of Treasury, and corporate bonds issued by large corporations, are both available to institutional and retail investors. Typically, these bonds are denominated in increments, with government debt ranging from as low as $25, like those savings bonds your grandparents may have bought you when you were born, all the way up to $100,000 or more, while corporate bonds are typically denominated in $1,000 or $5,000 increments. Another type of corporate debt is called commercial paper. This type of debt investment is not typically held by retail investors, as the minimum amount to invest is usually $100,000. As you know, interest rates change regularly and new bonds are issued often. An investor can normally sell a bond before maturity if they wish at a market price, and can normally buy a bond before it matures from another investor. This brings us to a key rule about bonds and interest rates. Generally speaking, when interest rates in the market go up, the price of existing bonds held by investors will go down. And when interest rates in the market go down, the price for existing bonds held by investors will go up. This rule applies to bonds with a fixed interest rate only, since bonds with a variable interest rate will reflect interest rate changes automatically. Let's break that down because it's often confusing to novice investors. Let's say on February 1st, an investor is issued a new 30-year U.S. Treasury bond paying 5% interest. On that date, 5% interest is the interest rate the market is demanding to lend money to the U.S. government for a period of 30 years. That bond will also have a price that the market determines. Now, let's say over the course of 6 months, the Federal Reserve raises interest rates significantly, and on August 1st, a new 30-year U.S. Treasury bond is issued at 9%. Since investors can now get a much higher interest rate for 30 years on the new bonds, they're not going to be as interested in locking in their money at 5% for the remaining 29 and a half years with the earlier bonds. To entice new investors to buy the bonds at 5%, the price of those earlier bonds will need to drop significantly to compensate these new investors for buying the bonds at 5% interest. Again, as interest rates go up, the price of existing bonds will go down because investors can earn a higher rate with the new bonds. Conversely, as interest rates go down, bond prices of existing bonds will go up because investors can't earn as high of a rate with the new bonds. I don't expect you to be an expert in bond valuation by any means, but it is important to understand the relationship with interest rates in the market and the price of existing debt securities. There is another nuance I'd like to discuss that you'll most likely see if you do invest in debt securities. Some debt securities are issued at par value or par. This is just a term meaning that the security is issued at its denominated price, and then interest is earned separately from that price. For instance, let's say a $100 bond is issued at par value. This means an investor will pay $100 for the bond, and if they hold it to maturity, they will receive their $100 back plus any interest. Not all debt securities are issued at par value, however. Some can be issued at a discount or a premium to par value, depending on market interest rates and the demand for those securities. A specific type of bond called a zero coupon bond is usually sold at a discount but doesn't have any interest rate. U.S. Treasury bonds or T-bills are a type of zero coupon bond. For instance, let's say an investor buys a $1,000 one-year U.S. Treasury bill at a discount for $980. The investor will pay $980 for the T-bill at issuance and then receive $1,000 back when the security matures. The $20 difference effectively represents the interest that the investor receives, even though there is technically no interest rate set. If you take the $20 and divide that by the original price of $980, you get an implied annual interest rate of about 2.04% for that Treasury bill. As we discussed in class number 11, the U.S. government is viewed as having essentially no risk of default, while other governments and corporations have varying risks of default. One way to assess the level of default risk is to look at the credit rating of the bond. Just like individuals have a credit score, so do companies and governments that are borrowing money. The default risk of a debt investment is generally measured by 3 credit rating agencies: Standard & Poor's, or S&P, Moody's, and Fitch. Each of these credit rating agencies has a grading system for debt investments. For this class, I'm going to use the S&P grading system. Generally, a AAA rated bond is the highest quality with the lowest risk of default. As the grades go down, the risk associated with those grades go up. We then have AA, A, triple B, double B, B, triple C, double C, C, and then the lowest, D. Any bond that is graded triple B or higher is considered to be higher quality or investment grade. On the other hand, any bond that is graded double B or lower is considered to be lower quality or speculative, meaning they are very risky and have a higher chance of defaulting or not being repaid. These bonds are also called junk bonds. Furthermore, a bond with a grade of D represents that the borrower or issuer of the bond is in default. Risk grades are normally provided by brokers, but can also be located through a reputable financial news service online. These credit rating organizations are constantly evaluating bonds, and grades can certainly change. It's important to note that these credit rating agencies are not infallible, and credit risk is complicated and often subjective. As we'll discuss later, one of the primary causes of the subprime mortgage crisis was the fact that rating agencies did not fully understand or care to understand the risks associated with a special type of bond called a mortgage bond. Many of these bonds really had a significant level of risk, but were often given AAA ratings. Investors buying these bonds thought that they were very secure, but in reality, they were very risky. Generally speaking, as it relates to companies, bonds tend to have lower risks than stocks. A primary reason is that if a company ends up in bankruptcy, bondholders generally have a payment preference over stockholders. This means that if a company is liquidated and its assets are sold off, any remaining money will usually go to the bondholders before the stockholders. As such, stockholders tend to require higher returns than bondholders to compensate them for this higher risk. Since there are so many risks involved with buying and selling individual investments, such as stocks and bonds, diversification is such a key concept for most retail investors who are not trained or competent in evaluating the risks of buying individual stocks and bonds. As the old saying goes, it's not wise to put all of your eggs in one basket unless you're skilled enough to evaluate which eggs are best. Like me, Almost all of you are not skilled in this endeavor. Luckily, we don't have to be. We can make a whole lot of money by diversifying our investments. In our next class, we'll talk a whole lot more about diversification and various types of investment funds, including index funds. Now that we have some basics down, the material is about to get a whole lot more interesting. I wouldn't miss class number 17 if I were you. If you have any questions at all, I encourage you to contact me at opusmonetayquestions@gmail.com or comment below, and I will try my best to get back to you as soon as I can. Thanks for watching. If you found this content to be helpful, I'd like to invite you to hit the subscribe button and give us a like. You can find additional resources, insights, and motivation by following us on Instagram and TikTok. Also, we greatly appreciate your recommendations. If you think this content may help your friends and family, share the wealth and let them know about us. See you all in class number 17. Peace!